Hello there. Welcome to Commodities. Let's check out the energy complex right now, because at one point today we did see the oil price hitting the lowest since October. Even though there's a couple of arguably bullish factors out there, the Americans seizing an old tanker off Venezuela, and the International Energy Agency actually trimming its forecast for an oil glut next year. So there you have it. WTI trading near at $1.57 a US, and the global benchmark, Brent, near $61 a barrel. Let's check in on the metals, because the US Federal Reserve yesterday left the door open to yet more interest rate cuts in 2026, and that usually is encouraging for gold investors. And sure enough, gold moving closer to the record highs of this year. Remember, spot gold this fall got above, briefly, $4,400. And copper hitting a record high in London, $11,906 a ton, US funds. Now, of course, the price in the United States has been distorted by stockpiling to try to get ahead of tariffs threatened by US President Donald Trump. Let's have a quick look at the farm commodities here. There's a massive Brazilian soy crop, and that threatens to flood the world. Now, we can see that soybean futures are up, but American farmers, we touched on this yesterday on Commodities, the sales to China have so far been pretty minimal after the Chinese regime said it was going to lift a ban on American soybeans, because the Chinese can pick and choose where they get supplies of that crucial crop. And we're watching fertilizer stocks. I'm not sure, could we put up nutrient? Sorry, I forgot to put it in the system. NTR. Ukraine said its drones attacked 2 fertilizer plants in Western Russia. And yep, you can see they're up. These factories, though, they produce nitric acid, ammonia, and other materials that are also used to manufacture explosives. So that may have been what the Ukrainians were going after, and they're fairly small in context of the overall fertilizer market. But it seems to be boosting fertilizer stocks today. Not just Nutrien was up. We're also watching Suncor. Suncor unveiling plans for next year, and it includes growth targets for production, as well as an increase in share buybacks. The oil giant now expects total production of up to 870,000 barrels a day, and that would be growth of more than 100,000 barrels over its 2023 output, and it tops targets that were outlined last year. And Suncor also increasing the scale of its share buybacks. Let's get on to this intriguing story. We've seen a rotation out of many of the technology stocks, and some investors are looking towards energy producers south of the border. Let's get more from Bloomberg's Jeff Morgan. Jeff, I love this line in your story. The energy stocks, the oil and gas stocks in America for quite a while have been overhated and underweighted, but some investors taking a new look at them.
That's right. Overhated and underweighted was an interesting way to put it. That was Miller Tabak's Matt Maley. So it's an interesting case. Underweighted, most certainly. This is the one of the smaller groups in the S&P 500 now. It's been on a long-term downtrend in terms of its overall weight within the S&P 500, and is now at its lowest point outside the pandemic in at least the last 20 years. Overhated, that looks like it might be starting to change over the last 2 months. This has been one of the top performing sectors in the S&P. So while we've seen that rotation out of the mega cap tech names, out of those AI-linked names, especially from the end of October through about the middle of November, energy was one of the places that investors were rotating into, and it was one of the only 2 positive sectors out of 11 in the S&P 500. So worth noting. A lot of people on Wall Street sat up and took a bit of a closer look at the sector, partly because it is also, one, the cheapest sector of any of those 11 in the S&P 500, and because they continue to generate cash. So a lot of voices on Wall Street saying, even without any kind of help really at all from the oil price, these stocks have done relatively well over the last couple months.
Maybe we could pop up a chart, a 5-year chart for natural gas, because I guess there might be an AI connection here. That surging demand for electricity will need more gas-powered generation capacity, and maybe investors are buying into that thesis.
There is a little bit of a positive kind of look on natural gas, and that is also, I mean, it's helping certainly. A lot of the kind of the weighting in that S&P 500 energy index is towards the oil. And so that is kind of what has caught a lot of people by, it caught a lot of attention here. Yes, definitely the AI names and the data center build out, all of that requires a lot of power, and a lot of that power is going to come from natural gas. Natural gas prices have also been higher in the last couple of weeks, and that's been helpful as well. But it really is kind of the broader rotation story. Mm-hmm. Investors may be looking for, in some cases, a little bit of insulation. That the weighting, we talked about the weighting of energy in the S&P 500 being so low. Mm-hmm. Meanwhile, the weighting of the tech stocks is almost 30% of their market, so a third of the market. And if you are, weighted the way the S&P 500 is, you've got 30% of your investments in the tech stocks, and in increasingly a smaller handful of those names.
That's interesting, yeah. And people buying an index fund don't realize to some extent they're just buying a tech fund these days. Jeff, thank you very much. A fascinating story. Jeff Morgan of Bloomberg. Okay, we've got a very oily show for you today. After this, we are going to look at the U.S. seizing that Venezuelan tanker, said to be part of the global shadow fleet transporting sanctioned barrels. So the Americans seizing a Venezuelan tanker, said to be part of that global shadow fleet, moving sanctioned barrels. We're joined now by Matt Smith of Kepler. Matt, thanks for joining us. What do we know about this ship, please?
Yeah, sure, Andrew. Well, it essentially has been sat off of Venezuela since end of October, something like that. It was pretending to be elsewhere, so it was spoofing to say that it was off Guyana. But essentially, this tanker went and loaded in mid-November and then was waiting back off Venezuela. The last time that it was actually seen, though, we were able to identify it using satellite imagery. That's why we know that it was off Venezuela when it loaded. But you have this AIS transponder, which all of these tankers have switched on so that they know where other tankers are and other tankers know where they are. The last time that was seen switched on was in July. And so we know that this tanker has previously moved Iranian crude. It's again would have been loading this cargo to surreptitiously take this elsewhere. There was a ship-to-ship transfer done with the cargo, this tanker, early this week. Either way, this has piqued the U.S. interests here, and they have seized this cargo now.
And I was surprised to learn it is a big ship.
It's huge. So it's a VLCC, which stands for Very Large Crude Carrier, and that can hold about 2.1 million barrels.
You reckon that this is arguably a smart move by the U.S.?
Yes, it is, Andrew. When you consider they've brought all this naval presence off of Venezuela there, the worst case scenario would be some type of boots on the ground conflict there. But by seizing these tankers here, it would be, it essentially stops the revenue for Venezuela, kind of hits them where it hurts. And so this is actually a great way here to really hit the Maduro regime. And so it's not only this one tanker, right? We've just heard in recent hours that there are more tankers that are being sanctioned. But it's not only that, it's all of these shadow fleet. We see 60% of Venezuelan crude exports moving on this shadow fleet, essentially going dark. And so, the majority of Venezuelan crude goes to China simply because of sanctions. It can't go anywhere else. China is destination of last resort, is willing to take it. And so what this also does is it then deters other shippers because they don't want to go and collect a cargo there if potentially it could be seized by the US, not just the cargo, but the tanker itself. And so it plays out in a number of ways here to really put the squeeze on the Maduro regime and hurt them in a way which it doesn't involve getting boots on the ground.
In that this could reduce the flow of oil onto the global market, mostly to China, as you say. Is it bullish for prices?
Yeah, and that's interesting, right? Because typically what President Trump does is try to do things that is bearish for prices because he wants to see that price at the pump moving lower. And let's be clear here, the price at the pump has dropped below $3 a gallon on the national average. That's the first time in about 4.5 years. So he's got to be delighted with that. But to your point, yeah, sort of 450,000 barrels a day, something like that, is moving to China here that is essentially potentially getting taken out of the market. So there is that latent bullish influence there. This is a key thing, Andrew, right, in that the general backdrop for the oil market here fundamentally is for weakness. But every time we start to see the shift towards fundamentals, we see oil markets moving lower, a geopolitical event such as this happens to lift us higher again and leaves us kind of on a WTI or a Brent basis around that $60 level. And so there seems to be this geopolitical premium, whether it relates to Russia, Ukraine, whether it relates to Iran, whether it relates to Venezuela in this case, that is supporting prices.
So we're looking at a graph here of the massive increase in so-called oil on the water that we've seen over the past few months. Does this include these shadow ships that are sneaking around under a veil of secrecy?
Yes, it does, because we're capturing them via satellite imagery. So everything that is being loaded and exported out of Iran, which is close to 2 million barrels a day in recent months there, we are seeing via the imagery, and that is going into our data. Same for Venezuela as well. And so because of that, that is being included in the commodities on water number. Those two countries are interesting, again, because that is where a lot of this crude heads. Basically, all of the Iranian crude heads to China. And so we're seeing a lot of that floating offshore now, probably 60 million barrels, something like that, of Iranian crude, just waiting at the mercy of the Chinese to buy that crude and bring it onshore there.
And the Chinese have been significantly adding to their inventories, I guess maybe partly taking advantage of the low prices.
Yes, and I suspect that they may well do that again if we do see prices moving lower. But we are seeing record imports into China so far this month. Granted, we're only a third of the way through the month, but they are importing as much as 2 million barrels a day more than is typical there. And so this goes back to, again, a lot of exports that we saw hitting the market back sort of September, October time. So we've seen Saudi Arabia increasing exports, Brazil, Russia, US, all of these different countries all at once. That has boosted this commodities on water. China loves a bargain, and so they're coming in and absorbing a lot of this crude and will continue to do so if we see prices drop further.
And just touch on the fact that we have seen domestic gasoline prices in the United States dropping to their lowest in more than 2 or 3 years. It's interesting because, as you know, electricity bills have been climbing in the US. People aren't happy about that. So probably President Trump is doubly motivated there to keep the gasoline price down.
Yeah, exactly. There's that kind of oxymoronish situation there, right, where you're seeing that natural gas price. You showed it in the last interview there. We've seen it screaming higher. It's come back down a bit, but cold start to winter has ramped that up. But just because of the demand side of the picture, driving on power prices there. Gasoline, though, yeah, dropping below $3 a gallon is a real boon for the consumer. That really appeals to Trump's base. And you've got to bear in mind as well, while the national average is just below $3 a gallon, in some states, such as Texas, it's dropped below $2.50 a gallon there. So near 5-year lows, essentially. And as we kind of move through a seasonal period here where you do see demand coming off, you see refineries coming back in December, we should expect those gasoline retail prices to gradually edge lower as we move into January here, especially if we see oil prices continuing to gradually move lower as well.
is there a comfortable consensus? Oh, there's a glut in the world oil market. Could oil stage a surprise rally in 2026?
It doesn't seem likely, particularly through the first half of the year, simply because of the size of the surplus. Even if we're overestimating the surplus that is coming through, it is still going to be a large surplus anyway. So because of this, we should expect prices to be in check through at least the first half of next year.
Thanks very much, Matt. Really appreciate it.
Thank you.
Matt Smith, lead oil analyst at Kepler. Coming up, according to Bloomberg, British Petroleum was the highest bidder in the first U.S. auction for oil and gas drilling rights in the Gulf of Mexico in years. We'll have more after the break. Energy companies submitted more than $279 million US in winning bids for oil and gas drilling rights in the Gulf of Mexico. And this is after the Trump administration's announcement that it's allowing new drilling of Florida and California for the first time in decades. Let's get more on US offshore oil production from Brian Kessens, Senior Portfolio Manager at Tortoise Capital. Brian, thanks very much for joining us.
My pleasure. Thanks for having me.
We hear endlessly about the Permian shale, not that much about offshore oil in the U.S., the Gulf. Is it a significant source of U.S. crude?
It is actually. And the Gulf produces about 1.8 to 1.9 million barrels per day. That's up over the past few years from about 1.5 million barrels per day. Still relative to the overall U.S. Footprint of a little under 14 million barrels per day of production. Small relative to that, but it is meaningful. And to your point with the sale, over the longer term, it's going to become even more meaningful.
Was the bidding seen as strong? Was there a strong interest in this in these rights?
Yeah, the bidding was viewed as pretty strong, particularly as it related to bidding on a per acre basis. I think that there were a few things driving that. One, obviously, the Trump administration's been very pro oil and more oil production. There's a sense that the regulatory environment going forward is going to be a lot more constructive and favorable for the oil companies. There's also, frankly, just as it relates to some onshore and even offshore, there's just some diminished opportunities for meaningful growth, especially for a company like BP that doesn't have a lot of shale production today. I also think that what was helpful was we've seen, as it relates to the service companies, day rates are at very healthy levels as it relates to drilling for new production. And then the administration also lowered the royalty rate from historically it was around 16% to 12.5% for this particular auction. So I think overall that led to the interest in the bidding being pretty healthy.
I'm assuming the economics of offshore oil are very different, that the upfront capital cost is huge if you want to put an oil rig there. But then the deposits, do they last for longer compared to, say, shale?
Yeah, great. It's a great point. When you can bring a lot of shale oil online very quickly. And in fact, when you bring the well online, it has a tremendous amount of production, but then it declines pretty quickly over time. Different from the Gulf of Mexico, which has a really long drilling cycle. But then once the oil comes on, it comes on at a relatively stable level and can stay there for many years.
That's interesting. It's more like our oil sands, I guess, in that sense. Maybe not quite as long lasting.
The very good analogy is very similar to the oil sands, at least as it relates to the production profile, for sure.
I know it's always tricky to compare because of the different capital models, but is it a fairly low cost? I mean, Gulf of Mexico production, can it withstand low prices and stay economic?
Yeah, it's a great question. I wouldn't necessarily deem it as low cost. I think when you are deciding to drill offshore, you're looking at a very long crude oil price curve in order to do so, and you've got a lot of confidence that curve can remain generally higher for longer, or at least over the very long term is upward sloping. But generally over that time frame, the break-even costs are actually a little bit higher for offshore drilling versus shale.
Just touch on President Trump's move to allow drilling off Florida and California. That's already a political battle.
Yeah, for sure. He's. I think it'll be a little more challenging for those politicians to agree, but that, given it's offshore, it's federal water, so it can for sure happen. I think what it comes down to is obviously the president would like to see more drilling in those areas, and certainly in Alaska as well. What's going to come down to is how much ultimate recoveries do the oil companies expect from other locations that are not kind of the bread and butter of the Gulf. Florida and California, historically many years ago, we were able to have some confidence in production, but I think we're a little bit uncertain about how much ultimate oil would be able to recover from both of those localities.
What do you mean, geologically or politically?
Just geologically. A lot of seismic activity hasn't happened in those areas for quite some time, and arguably with AI, we have better seismic today. And I think that before any auction would take place, that the oil companies would be keen to actually get a look to see what they actually expect the ultimate recoveries in those two locations would ultimately be before they would be comfortable bidding.
While we have you on, can we talk briefly about the shale? Obviously, U.S. production, you're saying, I didn't know it was that high, almost 14 million barrels a day now. Whoa.
Yeah. We're near record highs for U.S. oil production, almost 14. Interesting, we came into the year just a little bit shy of 13.5, so we've actually seen some pretty meaningful production growth this year, despite the fact, and I just heard your previous chat, the fact that the oil prices really haven't been that exciting here, a little bit below $60 per barrel for WTI.
It's interesting, isn't it? With that weak oil price, the production still keeps going up.
Yeah, I think it partly just speaks to the resilience of U.S. shale, frankly, where the shale break-evens have continued to move down over time. The companies generally are just able to continue to do more with less. That means that their CapEx is actually coming down, but as it relates to their drilling and their completion activity, we're just continuing to gather or to gain more and more efficiencies there to ultimately get more oil out of the rock.
We've only about 1 minute left. What are you buying U.S. E&P stocks right now, domestic producers?
Yeah, good question. Well, for oil prices next year, we think that they're going to generally be between $60 and $70 per barrel, which is a very fair price. The E&P companies can make money. Where we're most excited about, frankly, from the producers, are those that are more focused on the natural gas side of things, whereas it relates to more LNG exports and certainly the power needs for data centers. We expect natural gas to be a big winner there.
Thank you very much, Brian. Really appreciate it.
Thank you.
Brian Kesson, Senior Portfolio Manager at Tortoise Capital. Wow, we had lots about oil today. Thanks very much for watching. The Close with Marilla Fernandez is up next.